And also what I've done, I use another platform which is called Guru Focus. Very good platform. It's a paid subscription. You cannot get access to this platform. You can get for 7 days, I think, free, but then you would have to pay $500 US, something like that. But I really like this platform because you have access to fundamental information up to 30 years for each specific company. And you can find it from different markets: US market, European market, Asian market, like Asia Pacific market. So it's a pretty good platform to use. All right, so let's have a look. It's the information still which provided is here similar to other industries. Let's start. The price currently is $15.7, right? Now there are a few ratios here. Okay, let's have a look. Price earning ratio. Current price earning ratio for this company is 8. Now, historical median for this company is 21. It is much better when P ratio is low. The lower this ratio, the better for us. So it means that in general, usually people paid $21 for $1 profit. Now they're paying $8 for $1 profit. So it's like 2.5 times less. So the company is definitely undervalued compared to what it was before. Okay. Then if we compare it to industry median, as I already mentioned before, when I looked at specific companies in this industry, they're all expensive. Now look, at the moment for other companies, in average, right, people paying $30 for $1 profit. So again, it's nearly 3.5 times higher than for this specific company. Now, forward PE ratio, same story. It's here it's 8. Okay, we just saw in FinViz it was like 6.8, and here we can see forward PE 8. Now, the difference is when different platforms, they can listen to the director, but then they say, oh, we don't believe in this particular case, we make our own adjustments to that specific projections. All right, so that's why when you look at forward PE ratio in different platforms, you might see different number. Okay, anything regarding the future, it might differ in different platforms. All right, so but still we can see that's much lower than in average in industry. Then price to book ratio 1.7. Book ratio, it means when you have assets, if you divide all these assets by amount of shares, and then you compare like, okay, that's how many assets you have for one specific share, and then the price of the share. So you can see it's 1.7. Okay, and then price to sell level, so it's how much you sell per share, and then multiply it by like compare with the price of the share, you can see 1.5. And just to pay attention that all other parameters are much higher. So this company, regardless what ratio you choose, it's much cheaper than it was in previous time, and also it's much cheaper than in general if you take the whole industry. Okay, this is kind of important. Now let's have a look here. Also, we'll have a look at some general parameters, so which we have to pay attention. Now we can see annual price high of the share and annual price low. We're going to analyze company technically in a few minutes time, but I just want to show you that in 2014, when it came to the market, we can see that the price fluctuated from $10 to $17. Now, guys, it's only $7, but when you kind of calculate the percentage, it's 70%. So it means that within 1 year, company moved up and down 70%. Right, so it's quite volatile. Now, if you look at 2015, from 9, like nearly 10 to 19. So it's nearly 100% move within 1 year. If you look at 2016, from 7.5 to 26. So it's like from 8, it's nearly 4 times, 400% move. So the company here is 100%, here 100%, here nearly 100%, here nearly 400%. So it tells us that this company is very volatile during the year. And can you imagine, even if you create one trade only a year, you buy it once when it lows, and then you sell when it highs, you actually can make it from 70% to 400% annually. Okay, that's how you can trade without, like only once a year, without like doing all these crazy trades which robots are doing now when they do 100 trades a day. Okay, but you need to understand when to buy. Okay, of course, it's probably close to zero probability that you buy at a lowest point and sell at the highest point, but at least understanding how to evaluate this company and when this company is cheap and when this company is expensive, it gives you certain kind of pretty good idea when to buy and when to sell. All right. So let's have a look at what market cap was. Market cap, it's the size of the company. If you decided to buy the whole company at that particular moment, how much you would have to pay for this, right? So we can see that in 2014 it was $2.2 billion, then 3 billion, then 3.5, then 4, then 4.9, then 6.9, and now it's 3.2, right? So why it dropped? The amount of shares exactly the same, but what happens? The price per share dropped down. It was $35, now it's $15. So it means for the same business, which if you decided to buy the whole business last year, you would pay close to $7 billion. Now you would have to pay only $3.3 billion. Okay, only $3.3 billion. If we had $3.3 billion, right, it would be fantastic. Now, also the good thing about it, look, they had some shares and they will issue new shares every year. So the amount of shares which they produce in order to attract some external investors, or probably most likely what they had here is not the additional issue of the shares, but probably kind of remuneration reward to their management. So they were giving kind of producing some shares in order to reward their like senior executives. But look what's happening right now. So instead of 226 million shares, so they have 209. Where do they go? They announced that they're having a buyback. At the moment, about $200 million. I think they announced for buying back their shares, which is pretty fantastic. It's close to 10, not 10%, about 7% of the whole amount of shares they're going to buy back. When they buy back shares, it means that the profitability per share increasing, right? And also usually when they start buying, they boost the price up as well. So it's kind of a good news for investors who buy those shares. Now you can see that year-end PE ratio. So it means that at the end of the year, financial year, I presume, they just look at the PE ratio at that particular moment. It is a different situation if you compare with the value line, because value line has average PE every year, whereas here end year PE. But still, look at this 191. Previously, it didn't have PE because it was losing money. Then at 191, then 25, 15, 11, 17. So it's quite high compared to current, right? So at the moment it's 8 only. So it's a lowest in the history PE, right now. How long is it going to be staying on that level? We don't know, because maybe at what point it was on the same level last years as well, but it stayed there, and then investors realize, oh my goodness, it's so cheap, and start buying it, and then it moves up like again to the whatever average PE is there. So now we already looked at those ratios. Now revenue per share. Let's have a look at revenue per share. Look, at 2012 they had no revenue, so it was a free platform. In 2014 they had $1 per share, right? So they generating revenue. So probably to start attracting maybe advertisers or probably some kind of paid users. And look, after that it started increasing. So it's a bit of drop here, but look, from 2015 to 2016, huge move, like from 70 cents to $2.6, then to $6, then $9, $10. And look, for the last year, it's kind of flat, even smaller. It was $10.8 per share, and now it's 10.4. Now, personally, I believe that it can like scare some people. Oh, look at this, their revenue is dropping down. It's a scary thing, but you need to understand what was happening last year and where they generate their revenue from. So it is a social media platform, right? And who advertise there? A lot of retailers, right? So a lot of companies who sell certain goods, and very often they attract people to certain local stores and etc. Now, what happened this year? There was a lockdown. A lot of businesses were closed down. And if you analyze other businesses which were looked in our investment club previously, majority of marketing companies, they suffered as well because the advertising budget dropped down. A lot of companies, they don't know what to expect. So what they start to do, they become more careful about spendings. So, and a lot of companies, including Facebook, including all the social medias where you put advertisement, they notice the drop in revenue. So question for us, is it a new trend and the company is going to lose revenue in next year and after that next year, or is it just a temporary thing which was based on the coronavirus pandemic? Okay, we don't know, right? So we will see it only when a company is going to produce next reports. The only thing you might perceive if you constantly keep an eye on it, so if they are going to announce their earnings in a couple of days, I think 1st to 2nd of December, not couple of days, couple of weeks, and then you can listen it. But we're going to look at technical analysis and we'll see what kind of moves usually this company does during the earnings announcement. Okay, so earnings per share, same story. We can see that it went from negative to positive in 2015, 10 cents, and then 700% increase in their net profit. So from 10 cents to 70 cents, right? Then to $1.6 to 1.9, and we can see it's kind of flat for the last 2 years. Okay, and this year, despite the decline in advertisement budget, a lot of businesses, it has the same net profit per share as it had last year. All right, free cash flow also growing. We can see it. It's dropped from last year, from $3.3 to $2.5. Now, tangible book value, it's actually grew. It's had a drop here and then it grew again. And Graham number is 15.6. Graham number, I believe it's here. I'm not exactly sure about this platform, but usually they show it's what's the kind of the value of this company in a dollar value. So Benjamin Graham, it's a kind of a founder of value investing, the person who taught Warren Buffett how to invest money. Warren Buffett changed it after that, certain principles added to his investment kind of strategy, but still Benjamin Graham considered to be one of the best investors of his time. And he has this time price, which is $15. So he believes if the company is below $15, then you already can buy this company. At the moment, it's 15.7. So it's about that level, right? Now, the low numbers, they represent exactly the same thing which we just looked like now, but only for the whole company, right? If previously we looked at individual share, so here for investors like Warren Buffett, he's not interested in how much money you make per share. He's interested how much the whole company. But generally, it's exactly the same thing because if you divide the total number, 2.3 billion, by amount of shares, which is right now, so you get $10.40. Okay, so it's exactly the same thing. Now, if you look at return on equity and return on assets, it's pretty good numbers. So they're above 20 return on equity. So whatever your equity, shareholders' equity in that business, it generates more than 24%. Now, the thing is here that this company doesn't pay any dividends. Now, and a lot of people are saying, oh, it is a bad thing. But then from other point, you think, okay, if the company doesn't pay dividends, so it keeps all the profit within the business, what does it do with it? Now, and how it allocates, because usually if the company keeps the money within the business, so they reinvest it. So, and we know that's return on their equity. So if you keep the equity there, if they made $1 and they kept it within the business, so they're generating roughly 24 cents per each dollar for next year. So you kept the dollar there. So next year, the same dollar is going to have a value of $1.4. So it's pretty good in this particular case. So that's why fast-growing companies with the increase of their income, they usually not paying dividends if they need cash to reinvest. So when they have plenty of cash and they don't know where to put it, so then it's a good time to put money into different other businesses. Okay, this is income statement. Let's have a look at also at balance sheet. Now, first of all, I want to point out here long-term debt. You can see it here. And in 2018, they borrowed $700 million. Remember, I told you that they bought this dating app, dating platform in 2007. So they borrowed money for that. Right? So the total debt after that started kind of stayed in around the same level, right? So around $700 million. Now the question is it a big debt? Can this debt bring the company down, and can this debt bring the company into liquidation level? So it is very important questions which you have to ask when you're choosing a company to put money on. Let's have a look. First of all, how much cash they have right now. So they have $420 million of cash right now. So if they decide to pay part of the debt, they don't have to pay dividends, right? So it means that they can give part of their cash and cover their debt. So more than half of their debt they can pay straight away. So from the cash which they have. So the second question, if we go back to previous slide, so what we see, guys, how much money a company making every year, right? So this is net income. And we can see that trailing 12 months, for the last 12 months, they made $417 million of profit. Okay, guys, do you think this debt is dangerous for this company or not? Now, they basically can pay this debt within next year, right? So use the cash which they have now, and also within the next 6 months or 7 months, they generate another maybe $300 million of profit, and they can pay this debt completely if they want to. I presume the reason why they're not paying debt is just because the cost of borrowings right now is very, very cheap. The interest rate right now in United States, like in Australia, at the lowest level. I'm not sure actually in China how much they're paying for, because probably they borrow it from China, although maybe they're borrowing from other banks in different countries. So, but interest rate is pretty low. Okay, and maybe for them, it's much better to reinvest money in different projects and buying other businesses rather than to paying the debt, which is cost for them very, very little. Okay, this is fundamental of this particular business. Guys, you can see the profitability of the business, you can see the growth rates of this business, you can see the valuation, is it expensive or not, and usually at that particular moment, I always ask, what do you think, guys, about this business? Is it a quality business? Is it a good business? Is it undervalued or overvalued business or average valued? Can you put, please, in comments, what do you think about this business? So if it is good business, put good business. If you think it's bad business, just put bad business, especially if you have some kind of better understanding of that. If you have this app, right, or maybe you're from China and you're kind of using this application and you kind of know, you can probably give us certain outlook, which I cannot give you. All right, so somebody's writing here, just a second. Okay, good business, good business. Okay. Okay, way bad. All right. Growing good. Wei, can you comment on your bad? Why do you think it is bad? What specifically makes you think that this company is bad?
Yep. To me, this company growth, it definitely is slower, much slower than before. That's why, to me, it is the main reason of the share price going down. And then there's a lot of other big competitors like TikTok. And yeah, it can't beat TikTok. So that's why it's going down. And then in the future, I will believe less and less people using it.
All right. Okay. Okay, good. Have you used this platform yourself? Have you seen it?
I have seen that, but I haven't used it.
Okay. Okay. Actually, the big competitor, which at least in all analytical articles which I looked through, TikTok never mentioned. But who owns TikTok, by the way? Because they were talking about Tencent. Tencent, they have another dating app because that's what creates the biggest revenue for, like one of the part of the revenue for this company, MOMO. Okay, so, and that's why they consider. In other things, the reasons why the decline happened, in the beginning of this year, United States what they announced, that they're going to kind of audit and kind of look at finances of Chinese companies more precise, like, I mean, more strict. So apply, and they, like Chinese companies, they have to provide more information. And it was based on, you know, this kind of like tariff war between Donald Trump and China. So at the moment, I'm not sure, because the Biden came into force. Maybe he will refocus on some different stuff. So are they going to do that or not? But definitely it's affected the price. So secondly, information about Tencent. It's the company name Tencent, which also launched dating app, and a lot of people believe that it could be a big competitor for Momo, this thing. And also, like in general, like as I said, the economical situation with pandemic was pretty tough. But guys, do you know what happened last weekend? Like, it's the biggest deal probably in Asia Pacific region. Have you heard that they have this agreement that there are 15 companies which they created like a new consolidation, a new kind of deal, and now they're going to develop that deal. But if you compare with the other kind of like Canada, Mexico, United States deal, when they created this zone of trading agreement, and then European Union, if you compare those, this Asia Pacific deal is much, much bigger, because it includes countries with a population about $2.2 billion, or dollars, 2.2 billion people. And if India joins it, it's another 1.5 billion people will join. So it will be more than it's like a half a population is going to be. Now it's about 30% in population of the world. And from outcome, like manufacturing, production outcome, it's about also 30% of the worldwide production. So this deal is pretty big, and a lot of Chinese companies, or companies which are included in this region, they actually, I believe personally, they will benefit a lot. And also the tension between European Union and United States, for United States, it will be now more difficult to kind of to impose any sanctions or any tariffs, because that would be already like a union and not only one particular country. So the Chinese presence, I personally believe, in a world player game, it will increase a lot. Like, I mean, the position will be strengthened in this. So, and personally, I believe that this company also has certain potential because of that. Right? Yes, free trade agreement, correct. Now, that's great. So guys, remember, when you invest your own cash, you invest your own money. So that's why you have to personally believe in a company which you're allocating money to. So I'm just expressing my own opinion, all right? And usually what I do when I analyze any company, and if I think, so I usually put some money into this business, okay, just kind of, you say, I have to put my money where my mouth is. So that's what I believe, and I always do. So, but guys, you don't have to do that. So remember, this is educational webcast, and before you allocate any penny, you have to know certain things. First of all, if it is a good company and it satisfies your criteria. If it is undervalued company, and why do you believe like that? Now, thirdly, what's your plan? So at what price you're going to buy, at what price you're going to sell. And fourth, you need to have a plan B. So what happens if you are wrong? So if the company, instead of going up, starts sliding down. So you have to know how to protect yourself. Okay, and also you need to know how to kind of diversify your portfolio, how much money to allocate to that specific companies. For example, just 2 hours ago, I ran a similar podcast for my Russian audience, and a lot of people were asking, okay, the questions like that. So we've never invested in Chinese companies, so we usually invest in US companies. So what percentage of our portfolio we can allocate it? And some of them will say, I'm not putting more than 2% of whole my portfolio into the company from like Chinese market, because of political risk, not even because of the company risk, but some kind of political risk. Okay, so you need to understand how to answer all those questions before you put even $1 single in any business. Okay, guys. Now, this website, I just want to show you how the company usually reports their earnings. So we can see there are different dots here, and majority of them, they're kind of most of the dots, they're projections, and green dot is actual earnings. So the company is not only company itself, but the market, analysts, and Wall Street. So you can see the different guidance, estimates, consensus, company guidance, Wall Street consensus, and range, whatever. And we can see that it's got exactly where it's promised. Now it's a bit, they made more money, like the reports came up better than they expected, better than expected, better than expected, better than expected. Here, whatever they promised, here worse, and here worse. So 2 last times, they made, actually probably this one as well, so less than they promised. So for the last 3 times, 3 quarters, company produced worse result that they kind of projected in the future. So the question is, what is going to happen next quarter, right? And we don't know, so it's like a guess game. We don't have a crystal ball, right, in order to do that. But if you kind of don't know what to do, it's better just to keep watching it, right? So personally, I always recommend just to wait until the earnings announcement finishes, because yes, the company can jump in price and you can make a lot of money, but also it can drop a lot. Very often, the biggest moves, they happen during the earnings announcement. And it's much better, believe me, it's much better to miss the profit rather than to sit in a loss. Yes, if you don't make this 20% extra, you can make them later. But if you lost this 20%, after that you sit in this company for 1 year or like 6 months and waiting until it grows back, it's kind of not pleasant situation. So it's much better just to sit and wait, especially if you don't know how to hedge yourself and how to create income even if the price drops down. So it's much better just to watch the earnings and only after that make a decision.